If you think gold can go at some point to 20,000 as part of dollar debasement and devaluation, and when that crisis happens, the gold silver ratio can work against you. When that happens, I think you get peak crisis moment. And I've said you could get it higher than the last time, because this will be the crisis to end all crises. Many people go, how do you get higher than shutting everybody's businesses down? Believe you me, it's possible. It is possible. Debt-based collapse and all the banks zeroizing your money is something you didn't get last time. That could do it. So there is a potential technical signature for that, and that's where I got the values from. And it's quite natural to have a breakout and a return move before you shoot up.
Gold's setup in 2025 is becoming one of the most technically significant developments in global finance, with price structures aligning across multiple time frames and macro stress building beneath the surface. According to FrancisHunt, also known as the market sniper, gold is not simply preparing for a breakout, it's coiling within a multi-decade pattern that suggests the potential for a move toward $3,700 per ounce. Unlike speculative rallies of the past, this movement is being shaped by long-term debt imbalances, declining confidence in fiat systems, and the early stages of a systemic realignment in global capital flows. Hunt highlights what he sees as a macro bull market that has been quietly unfolding since 2000. While many investors fixate on short-term volatility, the larger structure, a massive ascending triangle, is nearing completion. Price behavior, even on the daily and weekly charts, reflects classic winding-up formation dynamics, signaling that an explosive upside move is more likely than not. In this setup, the gold-silver ratio plays a critical role. Hunt warns that in peak crisis, what he calls a holy crap moment, silver will likely lag gold significantly, potentially sending the ratio above 125. But once the panic fades and liquidity returns, he foresees an aggressive reversion, possibly even a brief dip below 10, as silver stages a violent catch-up rally. According to Hunt, this isn't just a chart story, it's a crisis playbook in motion. He envisions scenarios ranging from central bank bail-ins to global liquidity freezes and currency devaluations, any of which could trigger the next leg higher for gold. In his words, this is the crisis to end all crises, and when it hits, it won't just move markets, it could reset them. Now, we present the key technical insights from FrancisHunt's analysis. Before we continue, please subscribe to our channel and click the bell icon to stay ahead of these significant shifts. Thank you and enjoy the video.
First of all, we're in a macro bull market, and I will continue to say that, and I will continue to remind everybody. That means big time frames is largely up. I mean, even ridiculously long. But since 2000, you could argue you're in one long bull market. The difference is the pause period is you had a pretty lengthy period where you failed to make new highs between here and here, which some would have said, you're in a bear depending on your time frame of analysis. Most people considered that a bear market. And I'm okay with that. Most people are on lower time frames. But since 2000, in actual fact, this is a bull market. It's a macro bull market. This is the hugest winding up pattern that we've ever had on gold, in my opinion, an ascending triangle. Of course, if we throw the CPI on there, instead of looking so ascending, it has more of a symmetrical triangle vibe to it. But this is a very fresh new bull on the macro time frame. That said, if you start dropping to weeklies and dailies, there's going to be up days and down days mixed in. You don't get all your Christmases all the time. We said there'll be some chop round about the 2.9 level going to 3,000. That was your pullback. It actually wasn't too much. And then Trump did the tariff tantrum, and actually gold shot up. So gold actually did almost too well during the tariff tantrum, and it's my take that, so I'm bringing you into the more shorter term that most people operate into, slowly but surely. If you look at this on a 4-hourly, this is probably winding up. We said, guys, this is a grind. You're going to break the red line. Just like when you were selling off, we said you're going to break this red line to the upside. So that was a downward biased megaphone over here, like that. And you broke it to the upside. But this is all part of, much like the treasuries. And I want to remind people, the trade is dump treasuries, buy gold. Treasuries are gestating with their yields quite close to the high, but coming off. Gold is gestating and winding up with gold quite close to the high, but coming off. exactly as we predicted on that red line. There was someone who was saying it's about a breakout to the top. We said, no, you don't grind upwards like that and then suddenly break out. You're winding up. On balance of probabilities, you're winding up. So this is a longer process, but as I've already said, the UST's rates move through past the 5% and making new highs will also be a longer process. So if I just get a bit more real estate, these are all typical technical structures where I would expect it to do. Essentially, you've done that. I would expect that. I would expect that. I think you need a down leg, and I think you can come a little lower. You could do this, and then you could do that and that. And then we all want to be in the trade. And we gave one of these winding up opportunities to a lot of gold channels where we appeared, and on our own Market Sniper, that Market Sniper YouTube channel, when it was right down at 2000 earlier. And we gave quite a few along the way as well. Here's another, jump on in, have largely upside, boom, makes the target, pull back. Then another wind up at the target. Okay, get back in here, boom, another key move. This was on quite a small time frame, but the original one was actually go back to the daily time frame, right the way back down here. And we said, everybody, there's rare moments where even if you're not a particularly great trader, but you can know how to set a stop loss, you're going to do pretty well, even without having great skills. This is a unique setup. Get long here. We still have that original risk reward in there. It was massive. And you could have had your stop. You could have got in early on that, your stop there. We were putting in entries there, and it kept on trucking, and there it is. That's when it made the target. And what did it do after the target? Chronic pullback. Okay, not that chronic in terms of the long run, but if you were on leverage, it would have been a little bit uncomfortable. It would have been like that period as well. So my expectation is the next version of this is currently forming here. There. I'll try and get them both on screen. It's a little bit of a sketchy effort here. We're on the daily time frame, but it's going to be a bigger version of it as well, which usually means the bigger the setup, the bigger the move. There's a proportionality. So we gave this breakout. This was an excellent time to go leverage long if you know how to manage a leverage trade, and you definitely an investment. And I think you're going to be getting something along the lines of that. Just by the way, the geography, the geometry, not geography, 3.5, and that went down to, what was it, around, let's get a number for you. The pullback to its absolute low was around 3,120. So that's about $380 worth of upside geometry projected, I would expect, from about 3,350. So you put 350 on 350, this will take you to 3,700s. And ironically, we'll have, for other technical reasons, a target at 3,694 out of this move here. So this is what I love about technical analysis, when you get agreeing opinions for different geometric reasons. So that's a pole from that low pullback to that blow off. And this is all a continuation pattern. That also brings you to 3.7. So I could see 3.7 being the gain out of a leverage long trade, or that could come out of this winding up process. So that's quite an important and exciting time. What it does mean is, though, there's not much good trading to be done for a bit until that's ready. I think you still need some time. You need, it could even be 2 months. It could be 3 months. It could be 3 weeks. It could be 5 weeks, 6 weeks. It depends how fast things happen. If it were to come really hard and then snap back really fast, you could be and then have a minor pullback. You could have quite an ascending structure that could be breaking sooner than we think. But it points to 3.7. And remember, you normally beat the target. So we called for 2.9s, 3,000 from way back here. We said you're going to run the next 3,000. Before you had this turnoff, you actually traded as high as, so target should be beaten. The high before you dip below 3,000 again was on that candle, and it was 3,167. So having called 2.9s, 3,000, you went $167 beyond. before you had the first snapback, pullback of real strength, which brought you back to 2956. So you should make 37. It could go 3805, for example, and then come back to 3500s for a bit. That's how markets move. Price behavior is a fascinating topic.
The U.S. financial system is flashing red as underlying support structures begin to break down. FrancisHunt points to cracks in the U.S. bond market and weakening Treasury confidence as early signs that the dollar's long-standing dominance is unraveling. These aren't just technical pullbacks. They reflect core vulnerabilities, runaway deficits, excessive leverage, and systemic fragility, all of which are masked by manipulated interest rates and distorted CPI figures. The unwind is coming, and gold is the primary hedge. He expects the dollar to depreciate in real terms, sparking a wave of reallocations into tangible stores of value, such as gold and silver. The move won't be linear. It will come with false breaks, red candles, and misleading dips, but the broader trajectory remains intact. And once the unwind begins, Hunt believes we'll see a synchronized move across assets. Falling treasuries, surging gold, and a monetary reset that forces the market to reprice everything, from bonds to bullion. If this pressure persists, we may be on the brink of a generational shift in portfolio strategy, one that recenters around gold as the ultimate store of value.
The warning I've given is people are over presumptuous. This was supposed to be the move all the way back to 30s and 25s. It didn't happen. This was it. It had overtraded. That was supposed to be the move down to double digits. It didn't happen. It got held in a containment space. Eventually it will, but this is a cry wolf situation. You'll be wrong 10 times before you're right once. And I'm just warning people of that. I thought this was the beginning of the move. We saw this grinding. I thought that could be it. It could be it. We could finally be about to break the 75 and most importantly, the previous low, which is just below 65. Those two levels. That's the beginning of, going to possibly 10. And I think for all those that in your comments will go, he doesn't appreciate silver. He doesn't know how rare it is. Da, 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 da. I, in the end, think silver goes single-digit gold-silver ratio. I think you can dip below 10 when we have the full. The key point I'm making is you've got to have a political and economic absolute crisis. You've got to be in the peak crisis. Everybody understood CV19, lockdown, close your business. That was literally it. Everyone was like, holy crap moment. That's your holy crap moment, and that's when you have the highest ratio for gold silver. We are waiting the next economic crisis, and it's already here, but it's not at its peak moment. It's not in the, okay, everybody, you've got to stay inside your home. Amazon will deliver what you want to buy, close your business, and don't make anyone, the granny, sick. We haven't had that moment for this current economic crisis yet. And when that happens, silver gets sold off. And it gets sold off worse than gold because gold is the king. The central banks won't be selling off gold when that moment comes. They probably even have the day, date, and the lunar candle for when it's going to come. They'll be buying on the dip when it happens, and gold will dip far less. Because it's the king's money and the big people's money, the elites' money, I don't like calling them elites, I don't think they're elites, but the orchestrators, it's not selling off near as much. Silver, because of the industrial component still part of it, we're going to have a moment where there's no more ordering, there's no industrial capacity again in some degree. Debt-based collapse, bank-based collapse, pandemic Mark II, geez, list all the possibilities, but there's something coming for an untenable system. When that happens, you actually get an out of the blue, what looks like an out of the blue, blow off to the upside on the basis that everything gets sold. Everything that isn't nailed down gets sold. You're going to get a liquidity squeeze. People are going to be caught without cash. Iran went and zeroized our bank balances. We've got to go bomb them. They did this to us. We don't know how much money you had in your bank. Sorry, we'll give everybody an equal UBI. I don't know. Create a drama story of your own choice. No one is a master for that. There's many that have been seeded as potential. But when that happens, I think you get peak crisis moment. And I've said you could get it higher than the last time, because this will be the crisis to end all crises. Many people go, how do you get higher than shutting everybody's businesses down? Believe you me, it's possible. It is possible. Debt-based collapse and all the banks zeroizing your money is something you didn't get last time. That could do it. So there is a potential technical signature for that, and that's where I got the values from. And it's quite natural to have a breakout and a return move before you shoot up. And again, I refer you back to the first part of this discussion. Not yet for the unwind of the carry trade, but maybe not so far away. Medium time frame, I think we're going to muddle on. But there looks like a real USD JPY crisis. Not yet the gold, the upside break. Not yet the rates, the upside break. They're perfectly synchronized technically. They both need to wind up, and then they're ready to go upside. So I feel we've got the directions right. We keep on keeping on. We keep making money and getting endorsed by the markets. Don't stop doing it until the market gives you an alternative feedback. So in that sense, the peak crisis of this economic recession that I'm convinced we're already in and have dipped in and out of for quite an extended period, which will probably only be retrospectively acknowledged due to fake unemployment numbers, et cetera, is still to happen. And when that crisis happens, the gold-silver ratio can work against you. That's your base case. We made 100 and we pulled back. Well, that's not quite good enough, because we've made 100 before and traded 125. And the crisis that is coming in some way at a financial level is bigger than CV19. So it makes sense to be a little more circumspect about whether this is all done just because of 2 red candles. You know, you had 3 or 4 red candles here, it wasn't done. You had 3 red candles there, it wasn't done. You had a bunch of down leg there, it went higher. You had 2 red candles there and a hammer at one point, it wasn't done. And even the big rejection eventually, once you've done a blow off, did end in 2021 and actually wasn't allowed to play the whole way through. So the main collapse is yet to happen. Until we get 30s on the gold silver ratio, 35s, and I say my target is actually in an overreaction sub 10 for a day. It might just be for a day, a week, a month, like this was. You'll get an overreaction to the high side. You'll get in the same way an overreaction to the downside. We haven't had the whole story play out. So we're still waiting. That's my take.
While gold builds strength in stealth, silver remains the wild card with dual utility and higher volatility. FrancisHunt reminds us that silver's price action is heavily influenced by industrial demand, making it more reactive during downturns. With 80% of silver consumption tied to sectors such as solar energy, semiconductors, and electrification, economic slowdowns can hit it harder than gold during periods of peak panic. Yet it is precisely this duality that gives silver its explosive potential. Once the next liquidity event triggers a surge in gold, silver could follow with even greater force, especially as global supply chains stabilize and investor interest surges back. Hunt sees a path where silver could move well beyond its historical highs and possibly retrace the gold-silver ratio to single digits. Do you believe this historic gold setup and silver's reversion are already underway? Could gold hit $3,700 and silver outperform in the rebound? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.